This side Rahul Magan here as a Chief Executive Officer of Treasury Consulting PT Limited. And today we would be shooting another video which is of valuation of bond, duration, convexity approach. The reason for shooting this video is quite apparent. There is a lot of action which is happening in the world market, which basically can be divided into two parts, or apparently speaking. Number one, which is a trade war, because US wanted to import the tariffs on all the goods which are entering into US not being produced by the US companies, and specifically they are targeting a country called China. Not to mention more than $200 billion of tariffs which US would be imposing on China this year, which the media is saying. And of course I am 100% sure that China would surely be retaliating. The retaliation of China to the US would surely be impacting the emerging market and the common trading partners. So if you would have seen the Australian dollar is currently trading approximately 0.7390, which was at roughly 0.77. So practically speaking, there is a appreciation of more than 4 big figures in Australian dollar. New Zealand dollar, not much, and of course there is a lot of action which would happen in the currency market. So this is one side of the game. Second side of the game is the Federal Reserve. So right now, if you talk from my perspective, I predominantly think that the US is in action. US is in complete action, to be honest. Now, technically speaking, the Federal Reserve has already stated that they are going to be hiking the rate at least 4 times this year, and they did it 2 times this year. I am 100% sure that by September and there is another hike on the cards, and LIBOR would went up. It's already went up. All the forward rate agreements, they are going to be, in losses. You understand that from the buy side you would be in gain, from the sell side you would be in the losses. But in both of these issues, either it's a trade war or it's a Federal Reserve, there is one common similarity, an asset class which is hitting. That is known as bonds. Now, as we very well understand that there are predominantly 3 categories of that asset class from a tenure point. Number 1 is the discounted, which is 0 to 1 year. Number 2 is the notes, which is 1 year to 10 years. Generally, it will go to 15 years, shortly known as MTN, medium term notes. Third is when it crosses 15 years and it will reach to 30 years, maybe 50 years in the case of Spain. Here you are referring to bonds. Bonds is facing a huge volatility nowadays, and all the big hedge funds and the bond managers, bond portfolio managers like PIMCO, which is Pacific Investment Management Corporation, and so different companies, they are facing a lot of issues as far as the bond valuation is concerned. Take an example. 1 month ago, 10-year UST stands for United States Treasury. 1 month ago, 10-year UST went to 3.10%. On a very next day, Mr. Dimon, who is the chairperson of the JP Morgan Chase, amongst one of the largest bank, and Blackfin, who is the chairperson of the Goldman Sachs, give an interview that they both are expecting 4% yield by end of this year. I am with both of them. I am saying it's more than 4%, because if the Federal Reserve would hike the rate twice again this year, which is first in January, for the next time in December, and one which I'm expecting in December, by end of this December, the 10-year UST would be more than 4%. Now think from a bond trader point of view, how they are managing the bond portfolio. We people are reading Bloomberg TV, we are people watching Bloomberg TV, reading all the news and so on and so forth. For them it is quite easy. It's just a matter of discussion that the UST 10-year yield was it's practically 8.32%. It's quite easy for us to say that. But do you think that it is as easy for a bond trader to comment on? It's not. It's definitely not. There are a lot of issues which they are facing. There are 2 ways which they manage the bonds. Number 1, theoretically speaking, which is a parallel valuation approach. And I personally think that in 2018, all the fixed income books should remove these approach from their books. Reason being, parallel valuation approach means that if you have a bond of 30 years, and today if the Federal Reserve hiked your rate by 25 bips, which is currently 1.75%, expecting 2% in September, you meant to say that from today till 30 years, the yield would be parallelly shift by 25 bips. Excuse me boss, if that is your feeling, then my apologies, this is the wrongest thing. Another is which is a duration convexity approach. I think this is the right way. because duration convexity approach will also link one very important concept which unfortunately you will get only in the one paragraph in the fixed income books, which is spread risk or the spread duration. Like, take an example. Today you are a company, let me take you are a corporate, you are a private sector concern, and you wanted to take a bond into your book. Now you are subject to swap spread. Now that spread is now say 150 basis point, assuming it's LIBOR plus 150 basis point. Do you ever thought that the valuation of your bond is subject to this 150 basis point also? Generally people will say, let me write here, generally people will say, I have a bond which I have taken at LIBOR plus 150 basis point. The biggest misconception which I always see in the mind of the people is that this is the only floating element we have in the bond, and this so-called 150 is one of the fixed elements. Excuse me boss, let me tell you that theoretically speaking this 150 basis point is a fix. I'm not denying that. But every year the valuation of the company changes. You take any company, Google, Yahoo, you just take Apple, Amazon, Alibaba. The valuation for them, the valuation of all these companies every year is changing. So this theoretically is correct, but practically this is being done which is using spread sensitive swaps, which is SSS. Alternatively speaking, if I buy this bond from the market, people are saying this bond is of 30 years, so you would have some duration. We would discuss what duration is all about. Now, since you have some duration, you have some duration. Duration is nothing but basically that is nothing but an impact of the cash flow. So the higher the cash flow, the lower the duration. The lower the duration, the lower the cash flow. So for simple thing, that duration is nothing but the sensitivity of the bond pricing with respect to interest rate, provided the movement in the yield should not be more than 100 bips. So duration is nothing but the sensitivity of the bond with respect to the change in the yield, provided that that the change in the yield should not be more than 100 bips. If it is more than 100 bips, then we have to convexity. And if it is more than 200 bips or maybe 250 bips, then we need to go for duration convexity approach. This is quite lengthy topic. Now, how exactly it happens that this so-called 150 basis point also impacts the valuation of the bond, and that impact is known as spread sensitivity risk. So if the duration of the bond, I'm just taking a hypothetical example, if the duration of the bond is 4.6 years, although I have not yet discussed what kind of duration I'm talking about, but theoretically speaking, if the duration of the bond is 4.6 years, in that sense, strictly speaking, people tend to believe that this 4.6 years, that if there is a change in the yield by 1%, then the bond pricing will change by 4.6%. I'm with them. I'm totally with them. If it is more than 1% until 2.5%, then we need to take duration plus convexity. And if it is more than 2.5%, then we go to concavity. But people don't tend to write, do not saying you that it is actually not duration plus spread risk. And in second place, duration plus convexity plus spread risk. There are multiple kind of duration which we have. Number one duration is known as macular duration. Macular duration is nothing but a theoretical measure. People are not doing that. Nobody is interested. It is nothing but the weighted average cash flow. So if you are a bond trader and you know the bond pricing, that people really not interested in the macular duration. People are technically, it's just a wastage of time. But macular duration ends up, is nothing but an input. The one output which we are getting from the macular duration is the modified duration. And that is very important. Because if you are, let's take an example. I will give you two kind of duration. One is known as macular duration, which is 4.6 years. I will give you modified duration, which is 4.5 years. Modified duration would always be less than macular duration. Reason being, the formula for modified duration is the macular duration 1 plus YTM, yield till maturity, divided by N. I am always having skepticality from this formula. I don't know, this formula is, this formula is assuming the parallel valuation approach, which is practically wrong. But still, then we have effective duration. Let's take an example. LIBOR, London Interbank Offered Rate. I am issuing a bond which is L plus 150 basis point. I know that there is one floating element here which is LIBOR. That is subject to hedging. But are we talking about hedging here? No. We are talking about more than hedging. We are talking about how a bond trader manages this bond. For a bond trader, the concern are two. Number one, the floating part, which is LIBOR, and number two, which is the movement of the LIBOR. So sitting today, when the 1 year LIBOR is approximately 2.75, and if Federal Reserve would hike the rate in September, which is predominantly sure, then it would even cross 3%. In that sense, and if they do not hike the rate, then the LIBOR might come down to 2.6 and maybe 2.55 as well. Now, for a bond trader, LIBOR is a floating element. That is one thing. He need to hedge this using cross-currency swap. That we already had a lot of videos about that. But very importantly speaking, for a bond trader, the concern is that it might go to 2.5 to 3, which is the effective duration. So here you are, which is 2.75. If Federal Reserve do not hike, it will come down because market has already expected from Federal Reserve. If they hike, then it is 3%. Now, how would they manage it? Effective duration. Effective duration is one of the most fundamentally concept which I wanted to share. This is not the only definition of the effective duration. What else do you have a definition of the effective duration? There are a lot of bonds which we have who have covenants in place. Example, call options, example, put options, example, ranged option. Again, the irony of the life is that majority of the books, without quoting the name, are mentioning call option and put option, but none of the books is mentioning ranged options also. But anyways, we are not here discussing that. When these options are there, they are nothing but embedded options, and we all appreciate one fact that embedded options is changing. It will change the price of the bond, and basically embedded option, either it's a call side or a put side, they would have two features. Number one, it's a hard call period, and hard period and non-hard period. So for a call, this is hard call, the period till that period you not been able to take your money, and one is non-hard call period, you able to exercise your call option. Similarly is the put. One is the hard put period and one is the non-hard put period. For a call option you have call compression. For a put you have put truncation. I repeat, for a call you have call compression. For a put you have put truncation. Now the moral of the story is that once you have these things, these are known as embedded option that would surely be impacting the valuation of your bond. Now, as a bond trader, now I am asking a question. I have a bond, and forget that Federal Reserve is going to be hiking the rate. Forget that. Federal Reserve is not hiking the rate. Whatever the rate is, Federal Reserve is going to be stick till December. That's for sure. So this line is not relevant for the bond trader. Plus minus 10 bips, of course, nobody can guarantee that. You all understand that. Now, what the story is, but this bond would have a embedded option which is call and put. Now, what to do? Shall I go with the modified duration or shall I go with the effective duration? In that sense, I should go with the effective duration. The reason being, you can note in your diaries also, effective duration is a duration which takes the impact of embedded options also into consideration. And similar is the case for the effective convexity also. Like which I write here, effective convexity, point number 8. Either it's an effective duration or it is an effective convexity. Alternatively speaking, if you have a fixed income instrument in your pocket and that fixed income instrument is subject to the embedded options, then this fixed income instrument should be valued using effective convexity or effective duration. It should not be normal modified duration or the normal convexity. Now, another thing which we have already discussed, if the yields will go outside 1%, which is a normal phenomena, because unfortunately still a lot of fixed income books saying that the parallel valuation approach exists. I differentiate from that view. I'm saying that parallel valuation approach is nothing but a theoretical measure. The practical is that you have this kind of curve. So if today, like I wanted to counter them that if those who are saying the parallel valuation approach, if today the Federal Reserve would hike the rate by 25 bips and you'd use zero coupon swap pricing. So assuming today Federal Reserve, which is the federal fund rate is 1.75, it will go to 2% in September. Today Federal Reserve will hike the rate by 25 bips, assuming, and it touched down to 2%. And today I wanted to create a fresh bond of 30 years. I have two options. Number one, I will go to the BMK curves. BMK curve stands for the benchmark curves. I will go to the benchmark curves, and in this benchmark curves I would be able to make sense. I would be able to get the pricing of the existing traded bond, which is known as on the run. Now if I wanted to create fresh, then that is zero coupon swap pricing. In the zero coupon swap pricing, the impact of 25 bips might not be same by the time I will reach to the end of the period. So once I reach to the end of the period, the impact of the 25 bips might be reduced. So in the short run, it would be more than 25. In the medium run, it would be approximate 25. In the long run, it would be less than 25 bips. That is a practical thing. Similarly speaking, when the yield go more than 1%, then the traders are using convexity. Generally, convexity is of two types. One is known as positive convexity and one is known as negative convexity. When the yield is less than the coupon, I'm talking about negative convexity. When the yield is greater than the coupon, I'm talking about positive convexity. Unfortunately, a lot of fixed income books are too much sticking. A lot of business schools, MBA institutions are too much sticking about the word convexity. And the theoretical definition of the convexity is that when you will cross 1%. But people should also know that more than 1% is not all about convexity. It's 1% till 2.5%. And if you are saying, do I have any book which has said 2.5%? I don't. Reason being, it is something which being unsettled decided by the market. So it's roughly 1% to 2.5%, and greater than 2.5% it is concavity. Now convexity is of two types, positive, negative. When the yield is less than coupon, it is negative. When it is greater than coupon, it is positive. Last but not the least is nothing but the effective convexity, which is relevantly very important concept, which is effective convexity. Now I hope after this video you would have understood that a bond trading is not an easy thing. Next video we would be covering about OTTI test. Which is nothing but the impairment in the bond. This video was all about just to let you know that how the bond trading happens. For us, hiking a rate by Federal Reserve or not hiking doesn't make any sense. For us, it's nothing but a matter of a news which we write on the WhatsApp groups. But practically it is not that. Think from a bond trader. He needs to manage maculae, modify, effective, option adjusted duration, convexity, negative convexity, positive, effective convexity. And not only he need to manage this L, which is the floating element, but also this 150 bips. That L again is of 5 currencies and 7 denominations, so total 35 compositions. And this 150 bips will generate an issue which is known as spread duration. Changes in the price of the bond if the spread would be swing by more than 1%. Or sorry, if the spread would swing by 100 bips. Like if it is 150, it will go to 250. This is for today. If you have any questions, you are welcome to write to us. My mobile is 9899242978. My Skype ID is Rahul5327. Our email is rahul.magan@treasuryconsulting.in. Our platform is www.fixedincome.global and website is www.treasuryconsulting.in. Today on 29 June, after this video, I would like to make some announcement for everybody out here. The announcement is that Treasury Consulting is starting the email servicing, and that currently due to the bandwidth related issues we are starting email servicing once in a week. Hopefully once we have a good bandwidth service, we would be starting approximately 3 times in a week or maybe on a daily basis as well. This email servicing would cover the important updates about the market, the training programs which we are covering, the private placement which we are covering, and a lot of things which we would be covering. This email service which we are starting is the coming Tuesday. If I'm not mistaken, this is 3rd of July 2018, and after every week you will get this email service. If you wanted to get it registered to this email service, it's quite simple. You need to visit to fixedincome.global. In this, if you go down, you just need to register your name and your email ID, and you will automatically be a part of this email service. With this, we would like to thank you very much and have a wonderful time ahead. Thank you.